Welcome to Global Markets Brief, your source for professional financial analysis and market intelligence. Today we're diving deep into one of the most consequential developments in global finance, the synchronized pause by the world's most powerful central banks. The Federal Reserve, the European Central Bank, the Bank of England, and the Bank of Japan are all expected to hold interest rates steady in July 2026. What does this mean for investors, for markets, and for the global economy? Stay with us, because the implications are enormous. I'm your host, and this is Global Markets Brief. For the past 2 years, central banks around the world have been engaged in one of the most aggressive monetary tightening cycles in modern history. From near-zero interest rates in 2021, policymakers raised borrowing costs at a pace not seen since the 1980s, all in an effort to tame inflation that had surged to multi-decade highs. The Federal Reserve raised rates 11 times. The European Central Bank followed suit. The Bank of England hiked repeatedly. Even the Bank of Japan, long the outlier with its ultra-loose policy, began to shift its stance. Now, in July 2026, we appear to be entering a new phase, a global pause, and understanding why this pause is happening, what it signals, and what comes next is critical for anyone with money in markets. Let's set the global context. Inflation, which peaked at over 9% in the United States and double digits in parts of Europe, has moderated significantly. In the U.S., the Consumer Price Index has come down substantially from its 2022 peak. In the Eurozone, headline inflation has similarly retreated. But here's the critical nuance that every investor needs to understand. Core inflation, the measure that strips out volatile food and energy prices, has proven far stickier than central bankers had hoped. It is this persistence of core inflation that is keeping policymakers cautious, preventing them from declaring victory and pivoting to rate cuts. At the same time, the global economy is showing signs of resilience, but also fragility. Labor markets in the United States remain relatively tight, though recent data has shown some softening. In Europe, growth has been sluggish, with Germany, the continent's largest economy, flirting with recession. In the United Kingdom, inflation has been among the most persistent in the G7, creating a particularly difficult balancing act for the Bank of England. Against this backdrop, the decision to pause is not a sign of weakness. It is a strategic choice, a deliberate decision to assess the cumulative impact of 2 years of rate hikes before deciding on the next move. Now let's get into the specifics. The numbers here are striking in their precision and their unanimity. The Federal Reserve's July 28 and 29 Federal Open Market Committee meeting carries approximately a 95 to 96% probability of a hold, according to futures markets. The federal funds rate currently stands at 3.65%, softer than expected. Recent softer than expected CPI and PPI data have reduced near-term rate hike expectations, giving the Fed room to pause and observe. But Fed Chair Kevin Warsh has been unambiguous. The Fed's commitment to its 2% inflation objective is ironclad. Rates will stay higher for longer until inflation is durably under control. The current pause is a strategic choice, not a pivot. The European Central Bank's July 23 meeting shows a 95% probability of no change. This hold would come just 6 weeks after the ECB raised its 3 key interest rates by 25 basis points on June 11, 2026. That hike brought the deposit rate to 2.25%. Policymakers appear content to let that decision work its way through the economy before taking further action. ECB President Christine Lagarde's press conference will be the real event to watch. Markets will be listening closely for any signals about the September meeting. Rising energy prices, driven by Middle East tensions, have complicated the ECB's inflation outlook and could keep the door open for further tightening later in the year. The Bank of England's July 30th meeting is priced at 93% for a hold. UK inflation has been among the most persistent in the G7, and while the BoE is expected to hold, the debate within the Monetary Policy Committee about the appropriate level of restrictiveness remains active. The Bank of England faces a uniquely difficult challenge, an economy that is slowing but inflation that refuses to fully cooperate. And then there is the Bank of Japan, the great outlier. With a remarkable 97.7% probability of no change priced in, the BoE is expected to maintain its ultra-loose monetary policy stance, even as the yen languishes near 4-decade lows. The BoE's reluctance to tighten has been a source of significant market tension, contributing to the yen's weakness and creating carry trade dynamics that affect global capital flows. When the BoE eventually does move, and most analysts believe it will, the ripple effects across global markets could be substantial. The global average policy rate across major tracked central banks stands at approximately 3.56%, reflecting the cumulative tightening of the past 2 years. So what does all of this mean for investors? Let's break down the market implications. First, for bond markets, a synchronized pause by major central banks is generally supportive of fixed income. When the rate hiking cycle appears to be at or near its peak, bond prices tend to stabilize or rise as yields stop climbing. Investors who have been sitting on the sidelines in cash or short-term instruments may begin to consider extending duration, locking in current yields before they potentially fall. The U.S. 10-year Treasury yield, which has been elevated, could see some relief if the Fed's pause extends into the fall. Second, for equity markets, the relationship between central bank policy and stock prices is complex, but a pause in rate hikes is generally viewed as a positive catalyst for equities. Lower uncertainty about the rate path reduces the discount rate applied to future earnings, which is supportive of valuations. However, investors should be cautious. A pause is not a pivot. If inflation proves stickier than expected, or if economic data surprises to the upside, central banks could resume hiking. The risk of a policy mistake, either tightening too much or not enough, remains real. Third, for currency markets, the synchronized nature of the pause means that relative currency moves may be more muted than in periods of policy divergence. However, the Bank of Japan remains the key wildcard, and the yen's weakness has been extreme, and any signal from the BoE that it is moving toward normalization could trigger significant yen appreciation and unwind carry trades that have been a source of global liquidity. Fourth, for emerging markets, a pause in Fed rate hikes is typically positive for emerging market assets. When U.S. rates stop rising, the pressure on emerging market currencies and capital flows tends to ease. Countries that have been struggling with dollar-denominated debt burdens may get some relief. However, the higher-for-longer narrative means that the full benefit of a Fed pivot, which would come with actual rate cuts, remains some way off. Looking ahead, the key question for markets is not whether central banks will pause in July. That is essentially certain. The question is what comes next. There are 3 broad scenarios to consider. In the first scenario, the soft landing, inflation continues to moderate gradually, economic growth remains positive but below trend, and central banks are able to begin cutting rates in late 2026 or early 2027. This is the Goldilocks outcome that markets have been hoping for, and it would be broadly positive for both equities and bonds. In the second scenario, higher for longer, inflation proves stickier than expected, forcing central banks to maintain restrictive policy well into 2027. This scenario would put pressure on rate-sensitive sectors, increase the risk of a recession, and keep bond yields elevated. It is the scenario that Fed Chair Warsh appears to be preparing markets for. In the third scenario, a policy mistake, central banks either tighten too much, triggering a sharper-than-expected economic slowdown, or they ease too soon, allowing inflation to re-accelerate. Either version of this scenario would be disruptive for markets and would require a significant reassessment of asset allocations. The bottom line is this. The global central bank pause of July 2026 is a pivotal moment in the monetary policy cycle. It marks the potential end of the most aggressive tightening cycle in a generation. But it is not the all-clear signal that some investors may be hoping for. The path from here is uncertain, and the risks are real in both directions. For investors, the message is clear. Stay informed, stay diversified, and pay close attention to the signals coming from central bank communications in the weeks and months ahead. The press conferences, the minutes, the speeches, these will be the roadmap for where policy goes next. That's your Global Markets Brief for today. If you found this analysis valuable, please give this video a thumbs up. It helps more investors find this content. Subscribe to Global Markets Brief and hit the notification bell so you never miss our daily market analysis. We cover everything from Federal Reserve policy to global currency markets, from equity trends to fixed income dynamics. This is the financial intelligence you need to navigate today's complex markets. Thank you for watching. Stay sharp, stay informed, and we'll see you in the next video.